buy one call at 109, right? And I sell one call at a different strike price. So let's just say I sell that one call at let's just do 111. Okay. Good thing about Robinhood also that I like about it is that it does tell you your break-even price. That's something that you can easily calculate. Literally, you just add your price that you're paying for the contracts to your strike price, and that's your break-even price. So what that means, like a break-even price, is that if you have, like, you buy your option at 111, well, in order to break even, you have to have that price of the stock at 111.49. Otherwise, you're losing money. So I'll get back to that in a second. So back to buying one call and selling one call. You can do the same thing for puts, but I'm going to focus on calls right now. So on Microsoft, if I buy a call, I'm going to go to Thinkorswim on this one. It makes it a little bit easier. Not visually, but trust me, it does. So Microsoft, let's just say I want to buy a call at 109, right? Okay, let me make it down to 1. Okay, let's make this a call. Okay, so I want to buy one call at 109, right? This is what they call, and I've said this in the chat before, this is what they term a naked call. If I were to just buy this by itself, not have any quote-unquote insurance, then this is what it would be. I would just buy a call and hope for the best. Now, this is kind of, spreads are a way of, mitigating your risk. It's a way of, it does limit your profit potential, but it mainly limits your risk. So let me start by, talking about our vertical spread. So the other thing I want to do is do a separate strike price, right? So let's just say I want the strike price at 111. What I'm going to do is on Thinkorswim, we could just go ahead and do vertical, but I'll go ahead and just put, for the sake of Robinhood, I'll just do buy single. Let me see if I can add another one. Hang on. And then, does it let me? I'm not sure. Nope, it doesn't have to. Okay, so if you're on Thinkorswim, the way you would do it is you would do here buy vertical, and it would basically do sell and buy, right, at different strike prices. You could change the strike price. You want to keep it relatively close to each other, and that does change the price of it, though. So the closer they are, the cheaper normally it's going to be, and the further they are, the more expensive it's going to be. But let me put this in numbers so you guys can see this, because this is why I like Thinkorswim, because it puts everything in numbers for you. So let's just say, for numbers' sake, I'm going to open up a little sticky notes here. So let's just say I buy because I wrote this down earlier. Let's just say I buy a 109 call at 275, right? So that's just saying that you're buying the option price of 275, which is 275 per contract, and you're buying 100 shares, right? And it's a 109 strike price, okay? Now, you're also, this time you're going to sell, I'm going to put this right here, buy, and you're going to sell a 110 call at 221. Okay. Now, you can do the same thing on Robinhood. So if I go back to Robinhood, you can do the same thing. You can do a buy a call, right? And let's just do one contract. So 122. And you could sell a call at a different price. So say I want to set my limit price at, let's see. Oh, I already selected to buy it. Hang on. Okay. So I also want to sell this call at 111, right? Okay. And you can set the expiration on these as well. Now, here's some numbers for you. So the net price you actually pay, if you think about it, if I go back to these numbers, the net price you actually pay, you subtract these two. And so you're only paying 54 cents per contract, right? You're only paying 54 cents. So that what that does, instead of you, if you were to, let's just say this takes this away, right? If you were to buy this call, you're paying, $2.75 for a naked call, versus this one, you're only paying 54 cents, and you're mitigating your risk. Now, your break-even price also is another big thing. Your break-even price, if you do the math on it, it goes down to $109.54. That's huge, because then it limits your risk. If you do just a naked call, right? We'll go back to this. If we do just a naked call, then your break-even price is going to be $111.75. That is a huge difference, because you don't know if that stock could ride a wave and stay at $109 and you would expire worthless, right? Or it could even go up 50 cents and it would expire worthless. Versus this one mitigates your risk. Does that make sense? I just want to make sure that everybody's clear on that. I know this chair is squeaky. I'm buying a new chair. I actually just ordered a new chair, so. Yeah, I'll do the vertical call. Just give me 1 second. Any more questions, or does that make sense to everybody? Yep. Thank you, John. Did I miss that point? I'm sorry. I don't know what I said. What I explained is called a vertical spread.
Vertical spread.
Okay. Yeah, I'll get to iron condors in a little bit. Okay, so do you need me to go over vertical spread one more time, or did you get that concept? Just in simple terms, you're buying and selling. Right, it's four-legged spread. You're buying and selling a call at different strike prices. Okay. And so, let me go back to this. So when I look at my sticky notes, right, I'm buying a 110 call at 221. I'm sorry, buying a 109 call at 275, and I'm selling a 110 call at 221. So I'm buying, and what it does is, I'm going to pull up a graph here.
Vertical spread.
So I got this from a video. It's a perfect example. So this one, at a current price, is $75. This is stock XYZ. The strike price is at 75 is $5 per contract, right? And you're buying that for $750. Now you're selling your strike price at $85 as your strike price, and so your contract is going to be $1.25. So you're buying it for $250. Or I'm sorry, you're selling it for $250. So let's just say this stays, it goes past your break-even point. Your net cost of doing this is $500. Okay, That's not your net profit, it's your net cost, what you're paying for it. Yeah, don't worry about condors. Condors is a whole nother ballgame. So I was just gonna get into that. So your max loss. So the good thing about it, about these spreads, is that your max loss. Well, let's go deeper into it. Give me 1 second. Let me pull this up. So the max you can lose. Now let's go back to what I put in the sticky notes. The max you can lose, I put it at 54 cents is your per contract. Your break even, right? Or not your break even. Your cost. Okay. So your net cost is 54, right? So that's the net price you paid for the spread. Okay. So now, when you look at like a naked call, your 109 call, your probability of profit percentage is under 50%. Okay. Now, whenever you do a long vertical spread like this, your percentage of profit potential increases over 50%. Are y'all falling asleep? Don't fall asleep on me. I know this is boring stuff, but it's informational. Okay, so I'll kind of speed it up for you guys. I know you guys are falling asleep. So, okay. So the maximum, let me go back to your question. The maximum you can lose on this contract is $54. That's the max you can lose. Okay. And the max you can make on this, now this is where I get back to limiting profit potential. I may have done my math wrong in this one, but the max you can make is $58. Okay. So there is a cap on profit, but there is a high probability on success. So, more contracts equals more profit potential. So if you do want to buy more contracts, like say you want to multiply this by 3, like we were talking about earlier. So if I go back to Robinhood, you want to multiply this by 3. That is something you could do. And that is something that would increase your profit potential. Now, the second thing I'm going to go ahead and move on. We're going to go into the strangle option spread. So what a strangle is when you buy one call, right, and you buy one put. So this is honestly my favorite way to do it. I actually made quite a bit of money on this one. So that's a great way of getting a call cheaper. In a way that it's a way of getting it cheaper. But the thing is, if you were to get a naked call, you do have a higher, it's not a higher potential of profit. It's really just unlimited profit potential, if that makes sense. So it's not like you have a higher profit potential when it comes to, like, if you were to do a sell 110 call at 221 and a buy 109 call at 275, you have a higher probability of making profit, but you have a greater profit potential if you do a 109 call and say it shoots up to like 117. Does that make sense? So anyways, back to the strangle. So you buy one call and you buy one put at different strike prices. So let me go ahead and pull up this graph right here. So this is a long strangle. Okay. So this is your stock price at expiration, right? You have your profit and your loss. Okay. Now your max loss in this example is going to be $200. You can't lose any more money than that. So say I buy a put, I'll even give you a real world example. So if I buy a call at 109, but I also buy a put at a different strike price. Let's just say I buy a put. Let's see. Gotta give a good number here. Okay, so if I buy a put and a call at a different strike price, how is this different from? I'm sorry, I scrolled too far. Okay, you buy it at the same strike price. Don't listen to me. I was reading the strangle. I'm sorry. My bad, guys. I was reading a strangle. Okay, a straddle is what I need to talk about. A straddle is when you buy one call and buy one put at the same strike price. And so with this, the maximum profit is actually unlimited. So, can you not hear anything? Is my audio working, guys? Just make sure. I think everybody fell asleep. Okay. All right. So on a straddle, gotcha. So on a straddle, the maximum profit is actually unlimited, and you can also limit your risk. So if I buy a Microsoft, 109 call, and I buy a 109 put, okay. So I buy a put at 109, right? And I buy a call at 109. Okay. Now what does this do? So if the stock shoots up, your put expires worthless, right? But your call is the breadwinner. You just lost. Let's just say for easy numbers, you just lost $200 for that. Like the graph said, you just lost $200, and you made, let's just say, $400 on the call. That's a net profit of $200. Okay, and it can go either way. Now, here's how you can lose money. You can lose money if the stock stays relatively level. So if that stock, if I go back to this picture here, if that stock stays in this area right here, this strike price, this is a strangle, I'm sorry. Man, I'm really out of it today. All right, if it stays in between here, this is where you lose money, okay? Right? But no matter if you get to this point or to this point, no matter what, you're making money, and the profit is unlimited. There's no cap on this. Now there is a limit on things like contours. I'll get into that in a little bit, but there's no limit on this on profit, and that's what I like about it so much. This is what I use mainly. This is something that I have used on plenty of stocks to make me money, and I saw some of you guys in the chat also using that to your advantage. It's a great spread to use. Now, let me go back to what I was originally talking about. This is a strangle. Okay. Now, it's basically the same thing as a straddle, but you're buying it at different strike prices. So how is that different? It's different because when you expect the company, to go up, like Microsoft, right? You expect the company to go up significantly. You can buy a put at a lower price just so you can minimize your loss, right? So this is because the lower the price, the cheaper the option becomes. So if I want to have my my put, let's just say 105, I still have insurance here in case the stock takes a dip, they have a data breach or something, and it dips like crazy. I still have insurance here just in case, but I'm saving a little bit of money here because I really have a strong feeling that it's going to go up. Does that make sense? So you're limiting your cost, but you also are increasing your risk. So let's just say it does dip down below that call price that you bought it at 109, and it dips down between here, then you're losing money. That's the other thing. That's the strangle. So when you look at the picture here, you're losing money here, right? You're creating a wider gap by creating different strike prices. Your loss is going to be a larger gap if you're going to have this big of a differential. But again, your profit is unlimited on both sides. If it were to dip down and for some odd reason the market crashes and it dips down to $85, you're making tons of money. Or if it shoots up like crazy, you're making tons of money. But you do not want it to go in here. But the only way I would actually use this strategy is if I know for a fact like that this thing's going to shoot up. Like for example, I'll give you a good example. Krone, that stock I put in my watch list, I think it was a week ago. That thing shot up like crazy, and that's because of the buy. So because news things like that, like buyouts and data breaches, those influence stock prices tremendously. And so you'll have it shoot up like 30, 40%. And that's when when you hear that, you want to buy something like this. If you hear it before it shoots up, if you're already at 30% increase, there's no point in buying any options. That's the other thing I want to reiterate to people. If you see a stock and you just hopped on Robinhood or whatever, and you see somebody that's, the stock is at 20 to 30% growth, don't even bother entering, because when it hits around like 1 or 2 o'clock, it's going to shoot right back down, especially volatile stocks. So most smart investors are going to sell at 30% gains, just around 25 to 30% gains. So like I said, don't even bother trying to enter and put a call on, because it's not going to go up that much. Okay, same thing with Kron. Remember it shot up like crazy, went up, I want to say it was like 30%, went up to $12, hit a resistance point. Thing about it, and once it hits $12, it's going to sit right there at that resistance point, and it's not going to shoot up again for a while unless something else happens, which it did for a little bit, but then it went back down. But besides the fact, that is something to always remember for the new traders. Okay, so back to the strangle. This again allows for you to have more profit potential rather than a straddle. That's because you save more money by buying a cheaper put, if that makes sense. So does anybody have any questions before I move on to condors? I'm just going to talk about one condor, so it's not going to be long. But does anybody have any questions? Let's see. What's the last? At least you get profits for options. There's no number. I mean, there's a number once you pick the stock. Like this example I gave you, the least you can get for profit. Oh, on options. Hang on, let me see. You do know sell block of profit. It depends on what strategy you do. It depends on if you do a strangle or a straddle. That is unlimited profit potential. If you do like a condor, there's limited profit potential. If you do like a vertical spread, there's limited. Counter spreads, I'll get to that. I have your question in my list right here. I'll get to that in a second, T-Mix. Does your option lose value every day? Yes, it does. Always does. Every single second. If you have an option that you have sitting right now, it is losing value as we speak. Even if the market's closed, even if you're on the toilet looking at Robinhood, it is decaying. Always. You're not wrecked. You just have to use it to your advantage, because the thing about it, when something, right, that would be theta. So when something decays, it could either eat you alive, and you, if you don't know how to use it, and you don't know how to use options, that would cause you to lose a lot of money. But if you know how to use it to your advantage, then you can gain a lot of money. So, damn, I should have sold. Depends. It depends, because sometimes it'll shoot back up. You don't know. Depends on your expiration date. I'll ask you all individual questions after this. But okay, any questions about these spreads that I just went over? Please ask now, because I am really tired. So would the best be to sell? It depends. It depends on your stock. Like I said, on your option. If you bought it and it's an expiration of the 31st of December, depends on the stock. I would hold on to it. Like I said, it depends. There's no definitive answer to that one. Sorry to say. Okay, so no questions. Does your option lose worth every day? Okay, you already asked that. Okay, yes. Okay. Last one. This is for the people who have been using straddles and strangles and verticals. The last one, this is what I learned actually this month. It's called an iron condor. So basically what this one is you buy one call and you buy one put, where you also sell one call and sell one put. So what that looks like, I wish I had a better example than this graph. This graph, I know it hurts to look at. I'm not going to go over butterflies today. I'm sorry, guys. But the thing about a condor, I'm going to see if can I draw on this? Let's see if I can. Hang on. Is there, oh, I have paint. I do have paint. All right. Let me pull up my laptop. Hang on, guys. I got to touch. Hang on, guys. Okay. Let's move this over here. So let's say I have a stock, right? And let's just say it's trading at $75 a share. God, that's horrible. Okay. Well, in this case, I would want to, because we're expecting, let's just say a stock like Microsoft, we're expecting the stock to have low volatility, and we want it to stay within a certain range of a price. And you're going to buy all of these things, all of these calls and puts at different strike prices, okay? Now, why would you do that? This is because you don't expect it to shoot up and you don't expect it to shoot down, okay? Now, let's just say I sell a call at, let's just go back to the example I had at 110, right? Here, I'll undo. So 110 is our number, right? Does this work? Nope. I sell a call at 110. Or that's the price of the stock is 110. I'm going to sell a call, sell at top at 120. Damn, this is harder than it looks, guys. Okay, I'm going to sell a call at 120. I will draw it out better for you. I just don't have a stencil right now. Or not stencil, a little pen thing. Okay, so I'm going to sell a call at 120. I'm also going to sell a put at 100. Now, this is important because you want to keep the same distance between the price of the stock and when you're selling a call and a put. You want to keep the same distance. So this distance is $10. You want to keep that $10 distance, right? Okay. Now, when it comes to you want to buy a put at 95, okay, and you want to buy, I'm going to extend this graph, buy a call at 125, okay? Now, why would you do that? This is because you want this price, I'm going to do some dotted lines here, you think that this price is going to stay in here, right? You don't expect it to go above 120, and you don't expect it to go down below 100, okay? Does everybody get that? I don't know if everybody's following. Oh, later, teammates. I feel like I'm only getting like responses from 3 different people. Right, I'll label it right now. I know, like I said, this is a very complicated way of explaining it. This may show it better. Let me see. So if I buy, no, this doesn't show it better. This is the best way to show it. So this is, so you're selling, you're buying, and you're buying. Okay, and this is a put, this is a put, this is a call, this is a call. Okay? I know, guys. Hey, and again, I'm just learning this, so if I say something wrong, please correct me. But okay, so you're selling this at 2 different strike prices. Remember that. Has to be 2 different ones, and you want to keep them the same distance. Okay? So let me go to Thinkorswim here.
I'll show you what I mean by that. So 109 price. I'm going to buy an iron condor. So see what it does here? It's going to put the same distance between me selling and selling these two, right? Actually, I have to set it. So let's just say this is at 110. Okay. It's trading at 110, and I want to buy a call at 125. I want to buy a put at 95. I want to sell a put at 100. And I want to sell a call. Let me get back to my graph here. I sell a call at 120. Did we get that right? Let me see. I don't learn stocks. I self-educate myself. But when I real time, I'm not sure. I literally just got. Oh, is it right here? I don't know how to change it. I know I was delayed 20 minutes, but okay. But the reason why I do this, let's just go back to here. Say I think this is going to stay in here, right? Let me pull up this photo. Let me put this back real quick now that I've drawn this thing. Give me 1 second, guys. This is why I need a PC. Okay. All right. So I like to use this. By the way, if you guys want to look at, like, if I'm probably not the greatest person to explain these things. But if you guys want to look at places to view, like different trading options and stuff like that, this is the person to do it. So Skyview Trading is like the guy who taught me all of these different types. Okay, let me see. Okay, so let's go back to here. So this example, this one's selling at $75 a share. Okay, put it full screen for you guys. The stock price is $75 a share. So he put the distance of $10 in between, right? So he's selling a put, and this is at $2 per contract, and he's selling a call at $2 per contract. So at the time of expiration, let's just say it's December 14th. At the time of expiration, it is expiring worthless. So when he sells it, he's getting $200 on each one. Okay. Now on this one, you're buying a 60 put. Okay. It's $1 per contract, and this one is $1 per contract for buying a call and buying a put. Well, it stayed in between the price that you thought, right? In between one, for example, our example, Microsoft stayed in between 120 and 100. It stayed in between that number. So now it's going to expire worthless also. So you're going to lose $100 and lose $100. So now you're left with a $200 loss and a $400 profit. Well, then you're taking home $200. And the good thing, this is why I like Thinkorswim, is because this will allow you to do it all in one transaction. So I'm not sure. I know that you can do it on Robinhood. I've just been suspended. I can't really do anything on as far as my account goes. So yeah, there's options you could do. You have to have, in order to have those enabled, you have to have options experience on Robinhood before you can make those iron condor options happen, but like different types of spreads. But other than that, it is possible. So, but that is basically how an iron condor works: is that you're betting for the stock to stay in between a certain price, whatever you set it at. All right, so now that I'm done boring you with spreads, I'm gonna go ahead and answer some of the questions that were submitted. I got like 30 submissions, but only like 15 questions I think total. So if you guys have any more questions, I'm gonna keep the chat open. So first one is, and this is all gonna be anonymous, where to look for info before buying a call or a put. So I always try to steer away from the news, because it doesn't always have an exact outlook on a stock. And I'll go back to the John Hennigs example. You don't know if it's going to go up or down, but news does play an enormous role. For example, the Crone buyout was huge. Data breaches are a big one. For example, the Senate passed, I think someone said Senate passed a bill about farming or something like that. Another huge thing. Those things definitely influence stocks. Now, as far as if it goes up or if it goes down, that is something that we just don't know, because I'll give an example here in just a second. So the other question is, what are the best websites for alerts? One I use mainly is MarketWatch. That one I follow on Facebook and Twitter and stuff like that. Twitter is going to be your best friend. Twitter, they normally get the scoop before anybody else. There are some other ones that I've heard people use. If you guys want to like list some in the chat, that'd be great. I would love to use some, but I mainly use MarketWatch and Twitter, like stock alerts and stuff like that. Those are my favorite ones to use. And let's see, what are main factors to look at when buying a call or put? Like I said in the beginning, you want to look at how volatile is the company. Some other things is like, what's the resistance of that stock? You see in the chat like things like, I'll type it in right now. You'll see the resistance points and stuff like that. That's something you'll learn, and support levels. That's something you'll learn along the way. I'm still learning it, and if you guys have any questions on that, I don't know if you want to ask me, because I'm still learning it as well. But you have to look at that when it comes to buying a call or put. You also have to look at what's the risk to reward. This is why I like using spreads, because you can limit your risk, but you also want to measure what your risk to reward is. What indicators do I use for? I'm not sure. For Thinkorswim. Okay. Gotcha. For me, like I said, I just started using it. I like to use earnings. Earnings is a good one for me, because you'll see it'll change a lot after earnings. Like this one, for example, dipped down, and then this one, you'll see this is the dividends. Dividends went up after that. Earnings, and you can zoom in. Oh, I don't have my touchscreen. Shit. But you'll see it'll influence it tremendously. Earnings, I love to use that one. But as far as indicators, I haven't used much on it. I've been using Options House mainly, and a lot of people don't even use it. So I can't really go over what indicators I use. But and then let's see. The other thing is, I'm still learning another. Options House is E-Trade's version of options. And the other thing I'm learning is Bollinger Bands, or Bollinger. I don't know how to pronounce it, but it basically helps you characterize the prices and the volatility of stocks. If I had my E-Trade account up, I'd show you, but it's basically a band that goes up, and you'll see it on Webull too. It goes with the stock, and it'll help you predict the price, just not tremendously, but it'll help with noticing patterns and stuff like that. And speaking of patterns, kind of leads us to the next question. How do you identify patterns? I use candlesticks. I really like candlesticks. I got taught candlesticks when I first started using stocks. They're my favorite way to read charts. I can go over a whole section of candlesticks, which I'll actually, I took a screenshot a while back. I'll repost it in the chat. I discussed with somebody about candlesticks. That is just another way to read charts. And then let's see, what tools to use when trading options. 50 moving averages, 100 moving averages. Okay, so what tools I use candlesticks again. What I'll do next time is I'll go over stuff like when you see in the chat room from like the bots, like OI or TA, like I just posted, all that stuff. So I'll go over that, and then if we do another conference call. And the other thing is just stay connected with the news. Almost like a real estate agent. Your phone is your best friend. I actually started getting into real estate, something I'm still doing on the side, but you always got to be by your phone. Your phone is your best friend. So, and then as far as moving averages, I'm still becoming familiar with that. That's something I'm starting to research, so not sure about that one on that question. What is your strategy when it comes to trading? Do not let your emotions get involved. That is like my number one recommendation. Do not let your emotions get involved. This goes for real estate. This goes for stocks, anything. The reason I say that is because there was a stock, it was Dollar Tree. Their earnings came out a couple weeks ago. And I expected them based off their previous earnings. I'm gonna show you guys what happened. Okay. So Dollar Tree, if you look at their earnings, I thought I was a freaking genius. And their earnings were dipping down each and every time. Every single time. And I thought, oh my God, now is the time to buy a put. Like, this is perfect. But now, I bought a put, and as you can see, I don't know if I can zoom in. Yep. So I bought a put right about here, in this area, on the 27th. And sure enough, and I bought it to expire that week. That was on, let's go back here. Yeah, it expired on the 30th. So as you can tell, I lost a lot of money on that. I bought, I forgot how many contracts I bought, but yeah, I lost quite a bit of money on that because I let my emotions get involved. I was so excited to make so much money. I was telling all my friends, I was like, dude, this is going to be like amazing for setting a put. Let's do this. And I wasn't educated enough. I didn't, and I could have did a spread. If I did a spread, I would have been perfect. But I didn't take the time to, take a deep breath and actually think about it. So I think I lost just under $1,000. I started with 500. I was working my way up to, I had $2,000 in my portfolio, and I lost about $950 on that. So yeah, you really cannot let your emotions get involved. Just that's the number one. So I started with $500 out of my savings. That's what I started with. I'm at 1,000 right now, if you want to know. So okay. How do you time when to buy calls or puts? Read your candlesticks again. You'll look at here. I'll even show you this one. Let me exit out of this actually. So let's go back here. When you look at like a candlestick, let me zoom out. Okay. So best examples I want to use are hammers. So like when you look at something like this, when you see that it's dipping down more than it is going up, it tends to go down because you're going to have people that are buying or selling more than they are buying, is the way I like to look at it. It's not exactly what that means, but that's the way I like to look at it. So in that case, it definitely dipped down, and it went down quite a bit. And vice versa. You'll have this one actually called I believe it's called a hanging man, if it doesn't look like a hammer. And then the other one is an upside down hammer. So those are things you'll just have to start researching about. I had to do it myself, and I'm still researching about it because there's a bunch of different terms you have to learn about candlesticks. And then watch for when the stock tanks a lot. Like in the middle of the day, I see a lot of stocks tank. People love to sell off in the morning, and that is something that you need to take advantage of. If you know it's going to go up, like say Chrome, for example, they freaking tanked in the morning and then shot up. Slap a call on it. If you know it's going to go up, why not? But use these strategies, these straddles, strangles to mitigate your risk. How do you find support and resistance?
I stole this little excerpt from. Yeah, that's one mistake of me. I stole this little excerpt um, from where did I get it from? Investopedia. So once an area or a zone of support or resistance has been identified, so let's go to this for example. Um, Once it's been identified, it provides valuable trade, potential trade entry or exit points. This is because a price reaches a point of support or resistance. It will do one of the things, either bounce back away from that support, right? So Chrome, for example, it was going up like crazy. So let me do Chrome, hang on. So Chrome, for example, is going up. This thing was so low. Look at the 52-week low. This thing is stupid low, right? And it was around that area. It was at like 9. No, it was actually lower than that. It was at like $5 a share. It was pretty low. And it shot up because of the buyout, right? Well, it created a support level of $12.56. Now, what it means by a second support level is basically means if it surpasses this first support level, this is going to be your second line of resistance. Not line of resistance, but line of like support. I don't know another word for that, but and same thing goes for this. So this is a line of resistance. It shot up to like 1307, and it's going to resist at this point. It's going to come back down to an average of 1282. At least that's what I take from it. I'm trying to keep it as simple as possible. Okay. How do you calculate potential profits of a call or a put? Okay, so everybody pay attention. If you're not paying attention, pay attention now. Go to this website right now, if you can. It's called Options Profit Calculator. This is going to be your best friend when it comes to calculating your profits. If you want to know if like a call or a put or a spread is worth it. Let's just say I do a naked call, right? It's bearish. Oh, wait. Not bearish. Bullish. Oops. Okay, a long call. And I want to do Microsoft. 108.6. And I want to buy a strike price of this is puts, right? Okay, so calls. I want to buy at 126, right? Okay. So it's going to cost me $126. Like I said, times 100. Okay. Now, I'm going to calculate my profit if, and this expires on the 14th. Okay. So let's just say it shoots up. This is my this number that you're seeing here is the profit. That's already subtracting your, and this is the date right here. This is already subtracting your investment of what you already bought for the option. So this will calculate what profit you'll get. So you can have, if this thing shoots up to $119, you're making almost $1,000, and look at this, your max loss, $126, okay? That's what I love about options, okay? You have a lot of potential for profit, little potential for loss. So is everybody awake here? Hello? I really only see one person talking in the chat. I don't know. Someone's at the gym. I heard that. I should be at the gym right now. Okay. Well, let me wrap it up here. I got a couple more questions. So how far back do you read charts to determine whether to buy a call or a put? I like to look at the whole year first. Let me go back to Microsoft. I like to look at the whole year just to see how volatile the stock is. This one obviously is not that volatile. So, and then the other thing is if I'm doing like a shorter expiration, I look at like 1 month to 3 months. And it's the range that you really should be looking at. It depends on what kind of trading you want to do, like short-term or long-term. So, yeah, again, it really depends, especially on the expiration time. The other thing is the best time of day to buy a call or a put, there isn't one, really. There's no, like, I did say how there was like a time where they sell off, but you never know. So it really depends on the stock because we have no idea how it's going to go. We can only speculate. But I have heard that from the hours of 10 to 11 in the morning is a good time
to buy options because people have already sold off. And if you're going to buy a call or any kind of spread, that is the time. That is what I've heard. Don't you didn't hear it from me. That's what I've heard. So how do you determine what's the best time of expiration? It really comes down, and I think T-Mix was asking this one. It really comes down to two things: the cost of the option, right? So how much it costs to buy that option. So obviously, the longer expiration, the different, more expensive it's going to be. So if I want it out here in March, more expensive it's going to be. And then also, obviously, the length you're looking at. So Greeks help a lot, I've heard. I haven't got into it, but Greeks do help a lot. And then I'll talk a little more about that hopefully later once I learn a little bit more about it. And then you got to determine the volatility of the stock, how volatile that stock is. And then you also got to calculate the probability of your profit. This one is your best way to calculate that probability of profit. But it depends on what spread you do. This one does offer different spreads and stuff. So if you want to use that, they have advanced spreads to calculate profit. I love this tool so much. Volatile means how often the stock shoots up, like how high. Like for example, if I have a stock that shoots up for $100 to $110 within a matter of a day, and then shoots back down to like $95, that's in a day. That's like extremely volatile. That is the most volatile it could be. It depends. Like when you look at a stock like Amazon, it's the reason why it's not as volatile is because it's at like a medium volatility to me at least. But the reason why it's not as volatile is because it's a larger price of per share, and so it's going to be like like you'll have price swings that are larger because the price of the share is so big. Does that make sense? Like because I have a share that's like 100 and let's take a Krone for example. I have something that's averaging at $12 a share. That thing is not going to shoot up to, unless it's extremely volatile, it's not going to shoot up to $20. It's going to stay around this point, right? I am not recording this right now. I know some people are, and they said they're going to upload it, but I'm not sure, Stewie. I'm not sure. Excuse me. Yeah. Okay. I'm almost done here. So what are diagonal spreads? They scare me, honestly, because they have a maximum potential of loss. It's unlimited. It's unlimited loss potential, which scares me because I don't want to have like an undefined potential loss. Thank you, Steve. So I really try to steer away from that, but it's basically, in simpler terms, it's spreads, like different spreads, right? With different months and different strikes. I'm not even going to get into that. I really hate diagonal spreads, so I'm going to just avoid that concept. And then the last question is any advice for beginners? Honestly, don't get into condors yet. Don't get into different crazy spreads. Don't get into butterflies. Kind of just stay on the path. I love using straddles and strangles. Research that. Just honestly research. Start, and paper trading is a great option to use. And just research and try things out. Don't use your own money in research because that will hurt. Paper trading is the best option. I think Webull does it. Options House does it. I don't know if Robinhood does it. I'm not sure. But paper trade if you can. And yeah, just research, learn more, invest in yourself, really. Because if you don't spend the time to learn things, if you don't, you guys just took 2 hours out of or an hour and a half out of your day to sit with me and learn and better yourself, right? So you can be better as individuals when it comes to trading. And that's something that, I'm happy for you. And I'm actually benefiting from this. I'm learning as I'm talking, but I'm happy for you because you guys are growing and you guys are learning more about it. And that's just going to increase your opportunities. And so I hope you guys like really gained a lot from this. And if you guys want to do this again, please let me know, because I would love to do it again. I know I missed some points or I said some wrong things, and I'm glad you guys corrected me. I appreciate it. But yeah, this was a lot of fun, guys. All right. So any other questions before I close it out? Please let me know. Don't hesitate to ask. I'm still awake. He said, "What's your name?" Me llamo Kile. Of course, you guys. I'm here to help you guys out, and this is why I love this chat, because you guys are so willing to learn, and that's honestly what I love about it. So. John, I said Kile. It was just, I had someone when I went to Mexico, they called me Kile instead of Kyle, so I always say that. How do you get multiple charts open on Thinkorswim? If you go to here, this popped up for me. It's this little thing, and it says like to open up more and more charts. I don't even know how to remove them, so I think I removed them on accident, and now I don't know how to. So, oh wait, did I just remove them? Oh. Wait, no, that's not it. I don't know. I'll have to figure it out. Once I learn more about Thinkorswim, then I'll let you guys know. Of course, you guys. Any more questions, please let me know. Any more? We have like 17 people left. All right, I'm gonna sign off, guys. I appreciate everything. I appreciate you guys sticking through with me. The lone 18 people. You guys have a good night. If I don't, no, I'll talk to you guys. I'll be on the chat. If you guys have any questions, just shoot me a message. You guys have me on Hangouts now. That's like directly to my phone. So just shoot me a message. I'm always available. And I hope to see you guys making gains now, especially try out some spreads. I want to see you guys making spreads. I want to see you guys making money. All right. I'll see you guys later. Peace out.